Today, we open to a market demonstrating a tale of two economies. On one hand, the tech titans, the behemoths driving innovation, are showing remarkable resilience, even renewed vigor. The Nasdaq tracking QQQ surged, led by some of the most influential names in the tech landscape. Meanwhile, the broader S&P 500 benchmark also eked out a respectable gain, hinting at underlying optimism in certain corners of the market. But beneath this surface, the story shifts. Small-cap stocks, often seen as the canary in the coal mine for domestic economic health, faced headwinds, dipping into negative territory. This divergence paints a crucial picture. While large, well-capitalized companies with global reach continue to thrive, the smaller, more domestically focused businesses might be grappling with tighter conditions. This suggests a nuanced economic environment, where the benefits of growth aren't uniformly distributed. Adding to this complexity are the latest macro signals. Fresh data on U.S. inflation, specifically the Consumer Price Index, reminds us that the cost of living continues to be a persistent concern for households across the nation, even as some categories show signs of cooling. While the trajectory of inflation from 2019 through 2025 has seen significant peaks and valleys, its stickiness in certain sectors remains a key factor influencing consumer behavior and, by extension, corporate earnings. Simultaneously, the U.S. jobs report casts a long shadow. News reports indicate that millions of Americans are now considered functionally unemployed, a term that extends beyond the traditional unemployment rate to capture those who are underemployed, discouraged, or precariously employed. This rising number is a critical bellwether for consumer spending power and future economic stability. How these two macro forces, persistent inflation and a challenging job market for many, reconcile with the relative strength in big tech is the central tension we'll be exploring today. As always, the market's movements are often echoing the pronouncements, or even the subtle shifts, from the most influential figures in finance and beyond. Today, we have a chorus of voices shaping expectations. First, let's turn to the crypto world. Michael Saylor, the visionary behind MicroStrategy, remains an unyielding evangelist for Bitcoin. Yet, his recent comments suggesting that ambitious developers pose the biggest risk to Bitcoin's future are deeply thought-provoking. It's not about price volatility or regulatory hurdles in his view, but the internal evolution and potential fragmentation from within that could challenge its long-term dominance. This perspective adds a layer of existential contemplation to the digital asset space. Meanwhile, the titans of traditional finance are also making waves. Jamie Dimon, CEO of JP Morgan, finds himself entangled in a highly publicized, debanking, lawsuit with Donald Trump. This isn't just a legal skirmish. It underscores the deepening chasm between political figures and financial institutions, potentially creating ripples in corporate governance and the perception of banking impartiality. Then we have Jensen Huang, the CEO of Nvidia, a company that has become synonymous with the AI revolution. His advice on securing high-paying jobs in AI for normal people isn't just career guidance, it's a reflection of the massive economic transformation AI is unleashing. It suggests a future where adaptability and specialized skills, rather than traditional academic paths, will be paramount for prosperity, and his company is at the epicenter of that shift. Speaking of enduring wisdom, Warren Buffett's insights on dividend growth stocks being as certain as birthdays provide a timeless anchor in volatile times. While the specific names he once lauded face their own challenges, his philosophy highlights the enduring value of consistent, reliable returns, a stark contrast to the speculative fervor we often see in other parts of the market. Even eccentrics like Michael Burry, the Big Short investor, are re-entering the discourse, reportedly hyping GameStop again. This brings a touch of meme stock nostalgia and reminds us that retail investor sentiment, however irrational it may seem, can still drive significant market events and challenge traditional valuation models. Finally, Christine Lagarde, the head of the European Central Bank, reportedly stormed out of a Davos dinner. While the reasons remain speculative, such incidents, even anecdotal, feed into the narrative of geopolitical and economic tensions simmering beneath the surface of global cooperation, potentially impacting policy cohesion. These voices, each in their own way, are not just reporting the news, they are shaping the very environment in which markets operate. Let's shift our gaze to the bedrock of global finance, the bond market, specifically the US Treasury yields. The performance here is a critical barometer for interest rate expectations and the broader economic outlook. Today, the benchmark 10-year Treasury yield saw little movement, essentially holding steady. On the surface, this might seem like stagnation, but in the context of persistent inflation signals and ongoing debate about the Federal Reserve's next moves, no change actually speaks volumes. It suggests a market waiting, poised, unwilling to make a decisive move until clearer signals emerge from the economic data or the central bank itself. Why is this stability significant? For one, it provides a degree of certainty for corporate borrowing costs, which in turn influences investment and expansion plans. For mortgage rates, another area of critical concern for many Americans, stability in long-term yields offers a glimmer of hope. Many are desperately following strategies to get the lowest mortgage rates possible, and a calm bond market, even if yields aren't plummeting, at least avoids further upward pressure. However, this calm also reflects the conundrum facing the Federal Reserve. The Wall Street Journal reports that the Fed is set to pause rate cuts, with no clear path to resuming. This indicates that while the aggressive rate hiking cycle is likely behind us, the anticipated pivot to rapid rate reductions might be much slower than many investors had hoped. The bond market is digesting this reality. The higher for longer narrative for interest rates is very much alive. This wait-and-see approach from the Fed, reflected in the stable bond yields, directly impacts everything from the cost of capital for businesses to the valuations of growth stocks. When risk-free rates remain elevated, the future earnings of companies are discounted more heavily, potentially putting a cap on how high equity valuations can soar. So, while the numbers might appear static, the underlying narrative in the bond market is one of cautious anticipation and a recalibration of future rate expectations. The central banks are, without a doubt, the undisputed puppet masters of the global economy, and their recent pronouncements and actions are casting long shadows over market expectations. Starting with the Federal Reserve, the sentiment is clear. A pause in rate cuts is on the horizon. Despite persistent inflation challenges, particularly in certain sectors highlighted by the CPI data, and a somewhat shaky employment picture with millions functionally unemployed, the Fed seems committed to holding steady. This cautious stance by Jerome Powell and his colleagues indicates a delicate balancing act, fighting inflation without tipping the economy into a deeper recession. The January Fed meeting live updates have shown a consistent message. The battle against inflation isn't fully won, and patience is paramount. And in the United Kingdom, the Bank of England is facing perhaps the most optimistic outlook among its peers regarding future rate cuts. Jupiter bond managers are even projecting up to 4 rate cuts in 2026. This starkly contrasts with the Fed's current, no clear path, rhetoric and suggests a much quicker potential return to accommodative monetary policy in the UK, likely in response to their specific inflation trajectory and growth forecasts. What does this all mean for you, the investor? It paints a picture of diverging monetary policies. While the US Fed takes a measured, higher-for-longer approach, the ECB remains flexible, and the Bank of England potentially signals more aggressive easing down the line. These differing paths will inevitably influence currency movements, capital flows, and the relative attractiveness of assets across these major economic blocs. The era of synchronized global central bank action appears to be receding, replaced by a more fragmented and complex landscape. Now, let's turn our attention to the foundational elements of the global economy, commodities. Today, we're seeing some significant and fascinating movements, particularly in gold, oil, and natural gas, each telling a distinct story of global demand, supply, and investor sentiment. Gold, the age-old safe haven, continues to attract investor attention. It rallied today, extending its recent strength as investors increasingly seek safety amidst what Reuters describes as US policy jitters. This isn't just about inflation anymore. It's about a broader sense of uncertainty surrounding economic policy, fiscal stability, and geopolitical tensions. Gold maintaining its elevated perch signals a deep-seated apprehension among large investors. They're parking capital in assets that have historically preserved value during times of turmoil, reflecting a hedging strategy against potential unforeseen events. In the energy markets, crude oil saw a modest gain, while Brent crude experienced a slight dip, suggesting a mixed picture. The underlying narrative here revolves around supply dynamics, particularly from OPEC. The latest report on Iran's crude output from OPEC, December update, indicates fluctuations that directly impact global supply. Any shift in production from major players like Iran, whether due to sanctions relief, geopolitical stability, or strategic decisions, sends ripples through the market. The relatively contained movements today suggest a market still grappling with the balance between global demand, which faces headwinds from slowing growth concerns, and the disciplined supply management by key producers. But the real showstopper today in commodities is natural gas. We've seen an absolutely breathtaking retreat in US natural gas prices after an earlier, dramatic rally that saw them surge by over 117%. Today's plunge, a staggering drop, is truly eye-opening. This kind of volatility is characteristic of natural gas, a commodity highly sensitive to weather patterns, inventory levels, and production outages. Oilprice.com highlights this retreat, marking a dramatic reversal. The implications are profound. Lower natural gas prices can offer a significant cost relief for industries and consumers, potentially easing inflationary pressures in the short term, but also reflecting a potential oversupply or a warmer weather outlook that reduces heating demand. This massive swing underscores the inherent risks and opportunities in this volatile sector. These commodity movements collectively paint a picture of a global economy wrestling with uncertainty, seeking safety in gold, balancing supply and demand in oil, and experiencing dramatic price re-evaluations in natural gas due to shifting fundamentals. Now, let's drill down into specific sectors, where we see distinct narratives playing out, driven by both macro trends and company-specific catalysts. Technology stocks, represented broadly by the Nasdaq tracking QQQ, continue to be a powerhouse. Within this sector, the titans are leading the charge. Apple rallied strongly today, demonstrating robust investor confidence, perhaps on anticipation of new product cycles or continued market share dominance. Microsoft also enjoyed a significant uplift, reinforcing its position as a diversified tech leader benefiting from cloud computing and AI integration. Amazon, another cornerstone of the digital economy, saw healthy gains, reflecting resilience in e-commerce and its formidable cloud services division. Even with Meta Platforms showing a slight pullback, the overall sentiment in big tech remains undeniably positive. This strength in tech is particularly interesting in light of the macro narrative around AI spending. While popular assumptions often crown AI spending as the biggest engine of US economic growth in 2025, CNBC's reporting suggests a more nuanced picture. Other factors are at play, indicating that while AI is transformative, the broader economic resilience stems from a more diverse set of drivers. Yet, companies like Nvidia, implicitly benefiting from this AI narrative, as highlighted by Jensen Huang's comments on AI jobs, continue to drive significant market attention and investment. In stark contrast, the financials sector experienced a notable dip. The XLF, which tracks major financial institutions, moved into negative territory. This underperformance could be linked to the persistent uncertainty surrounding interest rate cuts and the potential impact on banks' net interest margins. If rates stay higher for longer, but loan growth or credit quality come under pressure due to broader economic slowdowns or the functionally unemployed data, financials could face a challenging environment. The news about United Health cratering on Medicare News, as reported in the stock market today's live coverage, further illustrates specific pressures within the broader financial and healthcare-related services, even if not directly a banking story. Energy stocks, represented by the XLE, managed a modest gain, largely supported by the upward movement in crude oil prices. This sector remains a play on global growth and geopolitical stability, and even minor positive movements in oil prices can provide a lift. Finally, small-cap stocks, tracked by the IWM, struggled today. This group often performs best when there's strong domestic economic growth and easy access to capital. Their weakness could signal concerns about tighter lending conditions, domestic inflationary pressures impacting smaller businesses more acutely, or simply a rotation of capital towards larger, more stable companies in an uncertain environment. Adding to individual company stories, GM stock notably hit an all-time high on upbeat results and a significant buyback plan. This highlights that even in established industries, strong execution and shareholder-friendly policies can drive substantial value creation. Let's dive into the fascinating and often volatile world of digital assets, where today's narrative is dominated by corporate conviction and evolving market dynamics. Bitcoin, the undisputed king of crypto, is experiencing some consolidation after its recent impressive run. While the exact numbers are fluctuating, the underlying story is one of a market grappling with sustained demand versus profit-taking. However, the most compelling headline in this space revolves around MicroStrategy. Yahoo Finance recently reported on why MicroStrategy's latest Bitcoin purchase is deeply concerning. This isn't just about MicroStrategy accumulating more Bitcoin, it's about the increasing leverage and concentration of a corporate entity's balance sheet tied to a single, volatile asset. Under the unwavering leadership of Michael Saylor, MicroStrategy has become a de facto Bitcoin ETF, a proxy for institutional adoption, but with the added layer of corporate debt to finance these purchases. Saylor himself, as we noted earlier, sees ambitious developers as the biggest risk to Bitcoin. This self-awareness, coming from one of its staunchest supporters, is a crucial detail. It implies that while external threats like regulation or market crashes are ever present, the internal evolution and potential for rival chains or protocol changes could pose an even greater challenge to Bitcoin's long-term dominance. Ethereum, the second largest cryptocurrency, also saw a slight pullback, moving in tandem with Bitcoin's consolidation. This often reflects broader market sentiment across the major digital assets. Beyond the pure price action, the crypto ecosystem is constantly evolving, sometimes controversially. Elon Musk's platform, X, has reportedly banned InfoFi crypto projects for posting AI slop and reply spam. This move highlights the ongoing battle against misinformation and manipulative tactics within the crypto space, especially as AI-generated content becomes more pervasive. It's a reminder that even in a decentralized world, centralized platforms still hold immense power to shape what is seen and, by extension, what is deemed legitimate. The confluence of corporate strategies like MicroStrategies, philosophical debates from figures like Saylor, and platform governance decisions from Musk all contribute to a complex, multi-layered narrative in the crypto corner. It's a testament to the fact that digital assets are no longer just a niche interest. They are intertwined with corporate finance, technological ethics, and mainstream market dynamics. As we look towards the rest of the trading session and into the coming days, several themes will continue to dominate the market's attention, offering both opportunities and potential pitfalls. Firstly, the nuanced U.S. economic picture, defined by persistent inflationary pressures, as seen in the CPI data, and the challenging employment landscape, highlighted by the functionally unemployed reports, will remain front and center. Traders will be scrutinizing every new piece of economic data, especially any further insights into consumer spending and manufacturing activity, for clues on the Federal Reserve's next policy moves. Remember, the Fed's current stance is a pause on cuts with no clear path to resuming, so any data that shifts this perception will be heavily weighted. Secondly, the diverging paths of global central banks will continue to influence currency markets and international capital flows. Pay close attention to any further statements from ECB President Christine Lagarde or Bank of England officials, as their differing rate outlooks from the Fed could create significant arbitrage opportunities or risks. Thirdly, the commodity space, particularly the volatility in natural gas, warrants close monitoring. Extreme price movements often present opportunities for nimble traders, but also carry substantial risk. Keep an eye on weather forecasts and inventory reports, which are key drivers for this particular commodity. Gold's sustained strength will also be a bellwether for global risk aversion and policy uncertainty. Finally, corporate earnings and individual stock performance, especially within the resilient tech sector and the struggling small caps, will dictate intraday movements. Strong performance from companies like GM on specific news shows that bottom-up analysis remains crucial. Conversely, any further negative headlines impacting financials or specific industries could trigger broader market ripples. The market remains a complex tapestry of interconnected narratives. Staying informed about both the broad macro currents and the specific micro developments will be key to navigating the opportunities and challenges that lie ahead. Alright, let's bring it all together for our final take. What's the overarching message from today's market symphony? It's a tale of remarkable resilience, but with underlying structural shifts that demand our attention. We are witnessing a fascinating dichotomy. On one side, the colossal tech companies continue to defy gravity, propelled by innovation, global reach, and the relentless march of AI. Their strength is pulling benchmarks higher, creating an impression of robust growth. Yet, if we peel back that layer, we see vulnerabilities. The struggles of small-cap stocks, the millions functionally unemployed, and the stickiness of inflation in various sectors remind us that economic prosperity isn't a uniformly distributed phenomenon. The economy, despite its headline numbers, might be a K-shaped recovery, benefiting the well-entrenched giants while smaller players and many households struggle. The central banks, particularly the Federal Reserve, are in a precarious position. The higher-for-longer posture on interest rates is a deliberate attempt to tame inflation, but it comes with the risk of stifling broader economic activity. The bond market reflects this uncertainty, and its stability today is more a pause for breath than a clear signal of future direction. And then there's the extraordinary narrative unfolding in commodities and crypto. Gold's persistent strength is a siren call of caution, telling us that significant investors are wary of the future. Natural gas's wild swings highlight the acute sensitivity of certain markets to supply, demand, and environmental factors. And MicroStrategy's audacious Bitcoin strategy, along with Michael Saylor's own warnings about developer risks, symbolizes the cutting edge of financial innovation clashing with traditional risk management. So, what's my final word for you? Don't be seduced solely by the headline gains in the major indices. Dig deeper. Understand the why behind the numbers. The market isn't a monolith. It's a dynamic ecosystem with vastly different currents flowing beneath the surface. Adaptability, a nuanced understanding of macro forces, and a keen eye on the narrative shaping each sector will be your most valuable assets.